today's concepts are very new concepts, and mostly these concepts are being followed by the advanced traders, advanced investors and traders, and mostly all these techniques are very advanced techniques, and these techniques are being followed by many fund managers also. So these techniques what you are going to experience today, these are the very advanced techniques followed by the advanced traders. I will present these things in a very simplified manner, and all these concepts are very new concepts. People may be telling you to fish out the stocks when the market will be falling, but you are encountering a situation when the market is at 52-week high. So thinking that 52-week high we do not have any opportunity to buy the stocks, it is quite wrong. So how we can enter to the market with a fresh investment when the market is at a 52-week high? So what are the studies are needed for that? So all those studies we are going to learn today. So for that, some critical calculations we have to do, very important calculations, very critical calculations, and for that you need the very simple calculations. For that you need the help of couple of Excel sheets and couple of, so you require couple of one Excel sheet and this presentation to understand those concepts. So I have already shared those documents with you. So here I'll be requesting you to download those documents from the handouts section. So download those documents from the handout section, and once you downloaded those documents, give me one quick confirmation, and then after if you want you can shift it to your computer from your mobile if you are viewing the things from the mobile. But the same documents I will not be able to send you by any other mean. You need to download it from handouts section. There is a handout section, you need to download from there. Other study if you want to do in this, then you need to search some resources associated with this particular concept. So definitely you will get a way out, but I will present this concept in a much simpler manner and which you can able to understand. So before I should start the session, I have specific informations to share with you. So this particular event is being scheduled today and tomorrow. So tomorrow we have the Hindi event. The same subject will be discussed in Hindi. So for this particular event of Hindi event, you need to register separately. So if you have registered this particular event today, so you are not automatically entitled for Hindi event. So for that you need to register separately in the same link. So same link. So here once you open the link, here the links we have already shared with you. So here this is the link. Once you open the link, what happens here, the two timings used to come, because what happens, we are creating a room and people are those who are, so both the events will be having the same time, different dates. So you just have to select the Sunday 7 to 8 p.m. this one, and you have to separately register for that. So the document what I have shared with you, that already have this link. I have given the registration link. So visit this link, and while registering, choose the date December 13th for Hindi events if you are interested in. So that is the process in which you can able to participate in the Hindi event. So today we will be discussing the subject in English, and also we have scheduled this year's last paid webinar. So 2020's last paid webinar on the option strategy. So this webinar registration is on, and another 39 seats are vacant. So if you want, you can book your seats here. So this is for this year's last event. And today's event is very, very special because this is covering many new concepts of investment and many different way of enhancing your profit in the investment, and mostly these techniques will be followed by the advanced traders. So for that reason only I have told you the handouts section 2 documents I have said. So please download those documents. So that documents I will not be able to send to you by email or any other mean. So I have already said, so please download it. And those who have downloaded it, just give a quick confirmation. It's being recorded. The recordings will be shared with you. So as I said to you, if you have not registered for the Hindi event, visit the link given in the document, and from there, just while registering, select the date, December 13th. So by this process, you can participate in the Hindi event, and all the associated documents are already shared with you. Fine. So I'll move to the session now. So as I have told to you today, many new concepts you are going to learn. While market is falling, you will be knowing that you have enough opportunity to filter out the stocks and enough ways or means or methods to identify a correct stock for investment. But when the market is at 52-week high, so what you should do? So what you should do when the market is at a 52-week high? So this is the correct way to invest in the stock when market is at a 52-week high. So there is a mathematical process, small process. So though it is a very critical process, you can able to explore many other means and ways to do that. So that is the first thing we'll be learning. And why this the idea of buying low and selling high doesn't work in the growth market like India, that also I will discuss. How to hedge your investment for first few months or all time. Why hedging is important for your investment? The reason is once you invest in any stock, doesn't mean that post your investment it is going to go up. So if you assume and presume that I have invested in this particular stock and it has to go up and down and I will never fall, then I cannot classify you as an investor. I can think that you may be in a dreamland which is not a true phenomena in the market. So here hedging your investment, if not always, the first few months of your investment is very critical. Because first few months when you have entered to the stock, so that time the phenomena will be different. Just give me a couple of seconds. So first few months, why it is critical? Because this first few months of period you have the all probability of going wrong in your decision process. Maybe you have technically did not understand the entry point, or you have entered in a time which was not proper. So nobody can able to do that. Even the best person who invests in that also, he cannot able to identify that yes, I have entered in a stock in a correct time and post that the stock will not correct. So for that reason only, initial few months it is the best thing that you must hedge your position. Then what is the correct time to book a profit and what is the correct way to book a profit? That also I will explain with a couple of examples. 2 examples I will share. So now first moving to our most critical process, choosing a correct stock to invest when the index is at a 52-week high. This is the very, very critical process of investing in a stock when the index is at a 52-week high. So here many other methods you can explore. I do not say that this is the only one method by means of which you can able to choose. If you have a specific interest in this subject, you may find out many different ways, many mathematical different ways. So here whatever the things I'm telling which is the simplest way, stocks having low index contribution factor, it is having the stock which is having a low index contribution factor is good for investment when the market is at a 52-week high. So this we will discuss in detail. Choose a basket of stocks based on observation which has not moved proportionality with index. So this is your job. Select first 4 5 stocks of any stock of the which is a component of that index. Nowadays many indexes are there, not only the Nifty and Bank Nifty. You have PSU index, you have many indexes which is being ET index also there. Economic Times also gives an index. So many index methodology has come, many different index has come. So you can find out any index of your choice. So from that index, choose a basket of stocks. So when I say about basket of stocks, 2 to 3 stocks or 4 stocks of your choice you can choose, and it is based on observation. It has no rule. You can choose any stocks. Then filter the stocks having the low index contribution factor. Analyze their fundamental. So when I say analyze about the fundamental, little have a look why these stocks has not contributed much in the index movement. Is there any management related issues are there, or is there any way the management our performance is going to be get compromised? So these are the things. Just have a new search and just a web search to find out what's is there anything wrong in the stock which is going to affect the pricings. So once these 3 observations are over, then you can able to easily invest in these stocks. So now I'll just give you the Excel presentation. So this particular Excel sheet also I have shared with you. So I'll be just removing this Excel sheet from the handout section. So what happens here, once I remove it, I can able to use this Excel sheet. So otherwise it will be in the read only memory. I can able to read only. So what I did here, I have taken the Nifty 50 companies, all Nifty 50 companies. So if you just have a web search, the index contributor, Nifty contributor. So if you just have this particular search, you will get that. So which one is contributing what? So contribution to Nifty and index, money control, you can go any site you can go, you will just get the details here. So I have taken it from the money control also. So here the stocks what you have, what is the last price, what is the contributions they are giving per day. On that day, what was the contributions they are giving. So this is the value you will get. So how that contribution is being calculated, that is you nothing to worry about that. So I got these informations, change in price, percentage of changes, and the contribution it has given. I have just selected some random 5 stocks, ONGC, SBI, Tata Motors, SBI Life, HDFC Bank. So this is the random choice. It is not having any specific view with that. So what I am going to do, I have chosen these 5 stocks with the anticipation that I am going to invest in any one of these stocks. That is with that, it is a random choice. There is no specific choice. You may choose ICICI, ITC, Bajaj Finance, HUL, anything you want. So once you just chosen this thing, you must have a 52-week low and current price. So 23rd March, Nifty was at a low, 52-week low, 7,610. On that day, what is the price of these stocks? Very carefully listen to this. On that day, what is the price of this random choice stocks? These 5 stocks I have written. So currently, so 11th of December, which was the last traded price in this last day on the December series. On that day, what was the Nifty spot and what was the prices of these stocks? I have just taken it. Then from the 52-week low to till date, how much points the Nifty has moved? Just a difference. 13,514 minus 7610. Now, 2 different approaches will go. One, the equal weightage approach, another the market capitalization index approach. The market capitalization index approach. Both the approach I will be discussing. Very quick calculations and it's an excellent calculation. So what we have to do here, there are 50 companies are in the Nifty, so that all of you know. So whatever this 5,904 points it has happened, movement happened from 52-week to low to this point. I am assuming all 50 companies has contributed equally in this 5904 points of movement. So what I did, I just divided it by 50. So I got the 118 point of movement. This is my assumption. It is not the true thing that yes, they have they have moved in this proper way. So what happened here? I have just taken the difference of it between the 52 high and this, and then I have divided it by 50. So once I have divided by 50, then my calculation starts from here. So here the contribution factor, when I calculate this contribution factor, so this is for the day of, you can say, 11th of December. So 11th of December, the ONGC moved by 5 rupees as compared to its previous close. So you can say that there is a 5% change, 5.62. Rupee terms, it comes to 5.15. Since the index contribution is in the rupee terms, not in the percentage term, what I am doing here, I am just dividing the contribution, which is a contribution index we need. So contribution, how many points it has contributed in the Nifty, plus or minus whatever maybe, divided by this 5 rupees. So this gives me a contribution factor of 0.82. So this particular 0.82 I am multiplying with 118. So till this point, I think you are correct. You will be understanding it very in a simpler way. I have explained. Just taken the difference between the Nifty current at the 52-week high points. What is the price? What was the 23rd March closing price difference? Equal weightage model divided by 50. So I am considering all companies are equally contributing in this movement, though it may not be true. So I have taken this. Then what I am doing here, I am just multiplying this contribution index with 118. So this gives me the 97.21. So what I have to do here, my expected price will be what was the price on 23rd March and how much price point I have expected. This I can add. So my expected price, if there is a equal contribution happens, then ONGC must be trading at 158 rupees. If the equal contribution happens, the SBI must be trading at 305. Tata Motors should be 161, SBI Life Insurance should be 570, HDFC Bank should be 970. What happens here? The current prices what I have taken here. So these are the prices I have taken, that this much of movement should happen, and once I have taken that, so there is a difference. See, ONGC is having trading at a 61 point less. So it is 33 point. This is excess of 17. This is excess of 279. So this is excess of 475. So what happens here? So one drawback is there, that equal weightage model doesn't give you the clear picture, that it says that these two stocks are highly underpriced and these are the highly overpriced. Highly overpriced and highly underpriced. What happens here? We got, as per the equal weightage model, we got this kind of picture. So why I am telling about that? So this is an inferior model, very inferior model. This model doesn't give you a correct estimation. But if it is not giving you correct estimation, then why I am talking about that? You must tell me. So here, why I am telling you these things, many mutual funds nowadays they are coming equal weightage blue chip fund. Many of you have heard. How many of you have heard that there is many mutual fund NFOs are coming? They are talking about equal weightage blue chip fund, equal weightage index fund, equal weightage debt fund. How many of you have heard about this term? Equal weightage. Devadatt ji has heard. Om Prakash ji has heard. So here equal weightage, when they talk, they assume that all stocks in our basket will equally contribute towards the index movement. Janji also had heard. so equally contribute towards the index movement, which doesn't happen. Practically, it won't happen. So you can't command that all 50 companies, if Nifty goes up by 50 point or 100 point, all 50 companies, you must follow my rule and you must equally contribute in that 100 things. This 100 point of move. This is market. This is a more democratic than our political system. It is stock market is more democratic than political system. They supports traders support a value stocks. Traders never go by this equal weightage model. So if that is not working or equal weightage model gives this kind of view, then how can we trust about those equal weightage mutual funds? So here, my point is, be careful when you are investing on this kind of equal weightage funds that they won't perform in a long run. So your investment objective will be missed. So it is not a correct product. I always say it is not a correct product. So then go for the next thing. So why I am telling about it is not a correct product, because smart finance also involves in the mutual fund portfolio management. We have a mutual fund section here, so people can invest in online through our website web portal. Those who are having their higher corpus also, we plan for them. So here this is a good information I have to speak, so I have told that. Now next model, what is the next model? So first you have understood that 509 points of movement, we have made that equal weightage model. So we have to go with the next model, which is called as a market capitalization index model. Market capitalization index model. Market capitalization index model. So which is MCIM also, many people used to say that. So here market capitalization index model, what we used to do here, so the moment we are calculating this contribution index, same time we will be calculating the market capitalization index. So what is the market capitalization index? So what I have to do, total market capitalization. So every company will be having the free float market capital, means this much of tradable shares is there. Other shares may be there, so they are not tradable. So maybe its share capital is more, but it is not tradable. So free float market capitalization, but it will be reflecting, it is a real time data, it will be reflecting all the time. So free float market capitalization, whatever is there, so we will sum it up in this index, what is the total value. So currently free float market capitalization, so 6730,776, this you are saying that. So I have just added these values, just added all your values. So only sum I have taken for all 50 companies. Then every individual company will be having one free float market capitalization. So that I am dividing here. I am dividing the free float market capitalization of that particular company which I have chosen, divided by the total market capitalization of the index. So I got two values now, contribution index, market capitalization index. So contribution index and market capitalization index. So these 2 points are going to help me now. So when you see same data points is here, what was the price on 23rd March? What was the price in the 11 December? So post that, what I'm doing here, there is a 509 point of movement. So what I'm doing here, I am multiplying the index price movement 5,904 points along with the stocks contribution index and the stocks market capitalization index. So these two values I am just multiplying. So this is giving me some price points. So I am adding it with the 23rd March low. So based on this, what I am getting here, my expected price for the ONGC should be 83 rupees. SBI 282. Tata Motors I am getting 105. SBI Life I am getting 558. HDFC Bank I am getting 1386. Just have a comparison. Earlier we have been seeing that HDFC Bank is 475 rupees overpriced. Now we are getting 3 rupees underpriced. So 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 say so we are getting it in the lower price. So this process have changed the entire scenario. If someone says me, out of this, which one you are going to invest now, I'll definitely say that my choice is for the SBI, my choice is for the HDFC Bank. If you go for the equal weightage model, you can say ONGC and SBI. So here you are getting a different view. Here, based on the equal weight, based on the market capitalization index model, it is telling that it is ONGC is also, so ONGC is also having the higher investments is not for a long period of time. Many of you appears in the stocks. Many of you think that okay, I'm a short-term investor. I invest for 1 month, I invest for 3 months, I invest for 6 months. Many of you will be thinking on that. So on that situation, using this market capitalization index model is a good thing to choose a stock. So my next presentations or next sheet is just an enhancement of this thing where I have just made for all 50 stocks. All 50 stocks of Nifty, the same data points, market capitalization is same. So here contribution ratio I have taken. Contribution ratio is nothing but change in the price divided by the contribution in the rupees. So this I have given. Market capitalization ratio, that also we have taken. What is the free float market capital divided by total market capital of the index. So that we have taken. November end, come to this point, November end, Nifty was at 12,968.5. So this is the November end. So currently we are at 13,514 rupees. So this difference I have taken 544.9. So November end, because where we stand that day, our day starts from there. So we do not worry about what happens in the past. Why to past postmortem? So today I am standing on 11th of December. My Nifty is at 13,513. 12,968 was the November end. Today I joined this event. Monday I want to apply this concept for my investment, because there is no point of learning if I am going to apply my concepts on after 6 months. So that normally I never used to do. Many of my programs I used to say that if you are learning today, Monday itself you apply this concept. At least do some paper trade. At least you track something so that the concept you can able to understand. So here I have taken the difference, and using this difference of 544, I have 544. So what I am going to do, I have multiplied this 544 with the index contribution ratio, market capitalization ratio, or market capitalization index. Both the things I multiplied for all stocks. And then what I did, November end, this is the price of, because this is the November end reference we have taken for the Nifty. So here the this is for demonstrating how far this method is true, and how much we would have expected in the November end, because this is the November end price. So we have expected November end 540.16 should be there. So there is a lacking here. Everywhere you will find out that there is a negative. Somewhere it is less, somewhere it is more. So somewhere it is less is there, somewhere it is more. You will find one peculiar phenomena here. So what we are doing here, the day we are sitting, from that particular day, we are calculating this price. This price. November end, what was the price? What we have expected on November? Using this price, though this price is not reflecting on November end, this price is being calculated based on 11th December. So we are just one future event we are mapping with the past. So it is, or the current event we are just mapping with the past, and we have found out that if this situation would have 544 rupees, if we would have got, or 545 rupees of move, if we have recorded at the end of November, then our pricing of this stock should be this. And now the difference, November end and our expected price is this. November end, this is the happened, and actually it should have happened 416. So by this process, if you find out all these ratios, here one peculiar thing you will observe: anywhere you are getting this difference as less than 1, very clearly you just see here, very important concept. Anywhere you find out the difference is less than 1, that particular stock has performed very great way in the month of December. In the month of December, that particular stocks, so here is a 5 rupees difference. So this difference I have taken November end to till date. There is a 5 rupees difference, 5 rupees difference, but when I take these things, the stock has returned only 2 rupees. Here there is a 14 paisa difference. You can say that stock has given a return of 157 rupees. So wherever you will be finding out a less than, majority of cases, less than 1 rupee difference, so you can say that those stocks has performed better way. So this is one way of analyzing that. Second way also we have, because this we are just mapping the current event with the past, so this is the difference we are getting. So second way we have, how we'll know that from now onwards which stocks to invest. So here I am just November end price with the expected price I am making. So here expected price based on future occurrence. So future occurrence, it is nothing to do with the November. So this 544 rupees happened today on 11th of December. So if I just altered this, so here November end price, so November end price, and instead of November end price, if I just take that here the last price of the stock and the expected price, so you can say this particular values you can get. So this particular value says, so both will be same, this value and this value will be same, because we are taking a common values here. So these values will say that the stocks which has already performed, so this is a Adani Port already performed, Asian Paint already performed, so you have a less performance in the Axis, you have less performance in the Bajaj Finance, so you have a less performance in this Eicher Motors, so you have a less performance here ICICI Bank. So these stocks has not performed in the month of December till now. So ITC also has not performed as per its value, so it still has the value. So these stocks you can filter now, those who are still in the negative territory, these stocks may perform in the remaining part of the December. So this is also one more way you can able to identify. So month end you take an analysis, just do these things in two different versions. Month end and the end of December, do the analysis, find out which of the stocks has not performed. So those stocks you can just choose for the month of January to invest. So this is also one of the great concept which you can utilize for choosing the right stock for your is not a good idea in the growth market like India. So what is a growth stock and what is a value stock, we must understand. What is a growth stock? When you talk about a growth stock which will increase proportionally higher as compared to the general market, that is known as your growth stock. Value stock, the stock which is undervalued as compared to its peer, so that is a value stock. So that is the classical definition. India is a growth market. If you would have seen that when the market has a big fall, that time itself I have released a video based on the 2008-9 comparison. 2008 and 9 we had a subprime crisis. With comparison to that, I have released a video. I have estimated and told you that 13,000 is not a distance dream. It can happen, because certain misconceptions follows that it is a growth market. What happens here? You have a population of 140 crores. Out of that, only 8 crores are only involved in the capital market, directly or indirectly. What about the other population? There is a huge mass of young population are there, those who are just getting aware about that. Whenever there is a growth market, we say any kind of demand side. So here demand is not saturated. So if there is a fall, you will find out that new investors or new breed of investors will come into the market. So many of you have heard that now there is a called some, they have given a classification, some new investors are coming, and Robin Hood investors. There is no such term called Robin Hood investors. Those people are the people those who wants to invest. They are our own people, our Indian people, those who wants to invest in the stock market for first time. They have never done it before. They have seen a market fall and they have come. So here once they come, so what happens here? The populations or the population to market participation increases. Population to market participation increases. Once that happens, definitely once that supply side will be absorbed, it will go up. So here India is a growth market. So always be alert for the next couple of decades, I can say 10 to 15 years period. You may not be entering to a market where you can say that it is a value market, it is a growth market, because our person to or the people to market participation is low. So fine, you can buy into different logics, whatever you feel, but I still feel it is a good place to do the things. And I have given you a way. 52-week market is high, that doesn't mean that you do not have any kind of opportunity to enter. You have always some opportunity to enter. You can filter the stocks based on the market capitalization index model. You can choose the best stocks to invest for 1 month period, 6 month period, for 1 year period. So whatever the period you are taking, based on that you have to take. So if you have just go to the 6 month, go back 6 months back and take the Nifty value. So here 1 month value I have given that November end. If you want 6 month back, so go back to the 6 month back. What was the 6 month back to till date? What is the price movement Nifty has given? 6 month back, what was the price of these stocks? What is the price of these stocks now? So you just do estimation and find out through this particular method, and find out that which is the correct stocks to invest now. So if you want 8 months back, 3 months back, same process you follow. Same process you have to follow. You find out the correct stocks to invest. So that is the process. You must invest in the stocks, because there are index companies, prominent index companies. They won't be, very rare cases they can go for the rotten states. Now, how to hedge your investment for initial few months to manage the, or few, all times also you can utilize this. How to hedge your investment for initial few months. Initial few months, why they used to hedge? So many of you will be involved in the mutual fund NFOs. How many of you have used to invest in the mutual fund NFOs? NFOs, distributors will tell this particular fund is in the NFO period. 6 months there will be a hedge. For 6 month period, as per the law, they will hedge their portfolio. How? You must probably you have heard these terms. If you ask your mutual fund distributor or advisor, they will tell, yes, it is a NFO. 6 months there is not a risk, you can hedge it. That means it is being your, wherever they put the money, they are also not confident that we bought into this. They have to buy the stocks based on your money invested. So once they buy it, they hedge it for 6 months. Why not permanently? So there is some regulatory hurdles. They cannot put the permanent factor there. They hedge it in that. So many different ways they hedge. This is, they do not hedge as per the topics what we are discussing. They hedge a different way. So how, as a retail player, we should hedge? So there are three different processes I can tell you can hedge. Buy a stock, sell a OTM call option having 0.25 delta, buy a OTM put having minus 0.25 delta. So what happens? So here you are put, you are buying, and you are selling a call. This is also negative delta. So you are almost 50% having a protection on that. Second, buy stock, sell a future, and buy multiple OTM call options having 0.35 delta. So this also I will show you some examples. Buy stock with credit call spread in the index ITM options. So this is also third way you can hedge it. So this is the three different ways you can hedge it. So I'm just giving you some examples. Here if you go for 100 stocks, 50 stocks, these things are of no use. So you can't able to use these things. If you have only 10 stocks I'm buying, you hedge it. So there is, I will say that, sorry, I cannot able to hedge that. If this a quantity is a one lot size or few lakhs are involved, you can utilize this. Or else it is of no use if you have only for 200 stocks, you want to hedge it. So what is the point of hedging? There is a very small amount is involved. You cannot, even though if you do not hedge it, it is better. So here, suppose someone is buying 3000 quantity of the SBI now or 272. So how he should be hedge this? So sell a 295 call options and buy a 260 put options. How he has derived? So here you can say that net hedging cost will be 1 rupee 45 paisa, and this particular, it's just nothing but a covered call with a put hedge it is being done, and this is having, though it is not delta neutral, it is just a hedge to protect. So here, if any of you are using our option strategy software, you have a grid scanner here, so you can get all the call strikes and put strikes delta, or else you have your own tools, you can get it. Anybody has any other tool, you can get it. If you have a scanner, grid scanner, so all tradable strikes, call and put options you got. So you have to filter out, hey, say 295 call is having 0.25 delta, and here also you can say that 260 put is almost near to 0.25. So these two strikes, 260 put I should buy. So why this 0.25 delta? So what makes me to choose this 0.25 delta? So what makes me to choose this 0.25 delta? That is more important. So what makes me this 0.25 delta? Why not 0.5 delta? Why not this thing? So when we choose this 0.25 delta, if you can say, almost there will be a price difference of 10% plus or minus will be there. The price where we are entering, from there is a 10% of plus or minus values will be there. So we are protecting our positions for a 10% oscillation. That. So if SBI goes up by plus or minus 10%, for that only we are hedging this with that 0.25 delta. So why we are hedging it? So 3000 quantity of SBI is near to 7 lakhs worth of value. So for 7 lakhs rupees to protect, if I am just spending another 4500, what's wrong in that? So 4500 you are spending to protect your 7 lakhs. That's a great thing you can do. If there is a, your investment 7 lakhs has corrected by 20% or 25%. So your hedge can protect. If it doesn't correct and move a 10% gain, so you get a 10% gain. So quietly you can just book that 10% and come out. So that is the way, or that is the process in which you have to. Second process, which is much more favorable for me, and I always favor this method, and I will be showing you multiple examples on that. You buy the equity, sell a future simultaneously, and you need to buy multiple call options and delta neutral approach having 0.35 delta, means here your future positions is completely hedged and you have a buying position in the equity. I'll show you multiple examples now, my own trades I can show. So by this process what happens, if the price goes up and off, you make a good money, and if the price corrects, okay, some hedging costs you can able to sacrifice, but same time it can bring down your cost of acquisition of this particular stock. Third process what I have told, if it is an index company, suppose SBI is an index company, you buy the index stock, so you must have a call spread, means credit call spread. You think of now it is 13,500, so we can have a 12,500 call option sell and buy 13,000 call option. So 500 or 600 points of credit you take it. If there is a correction in SBI, Nifty also will correct. So by that process also some amount of things you can able to do, but this is a very complex process. This third process you need to understand what is the index contribution, historic index contribution of SBI. So historic index contribution of SBI for a period of 1 year. Then you need to see that when it deviates, what is the deviation factors in there or standard deviation on that. Then only you can able to decide upon that. This is a complex process, this third one, but this you can able to do but second one is the very easiest method. So I'll show you a couple of examples also, and same also can help you to enhance your profit. See here, I am just showing you specific example. I'm just going to show you specific example. Have a look on here. Here I have bought the Gas Authority of India, two lots, quantity 12,200 quantity at an average price of 90 rupees. So this is clear to all of you. Once I bought at this value, that is 90 rupees, 12,200. So it near to 11 lakhs worth of investment is there. Can I leave this 11,000 in the investment, 11 lakhs investment just like that? Because I have invested, it will go up. Normally, many people used to do that, but I never do it. All my investment, the day I do it, whether it is 52-week low also, immediately I used to hedge it. So I have invested some period of time, over a period of time. So average has 90, and it has been earlier period also it is being hedged. It is not that it is being left out. So this was my last hedge, or still continuing with that hedge. It is a permanent hedge for me. What I did here, 23rd November, see the date here. 23rd November, I am selling same quantity future at 101. Same quantity. So if I leave this, then my 11 rupees profit along with the quantity of 12,200, this profit is guaranteed. 1,35,000 profit will be, if it corrects again to 90, I'll book a profit in this one. So this is completely hedged. This 1,35,000 profit is no one is going to take from me now, because it is in profit, though it is being hedged from 90 level. So that is a different aspect. But now based on this value, you just have a look. 101, it is being hedged here. What happens here? Same time, the November, when I am selling these two lots, multiple, so four lots of this 120 call option, I am buying at a 1 rupee 30 paisa average, the same day and time you can see that. 23rd November, 1 rupee 35 paisa. Four lots is being taken. Why this four lots is being taken? This is just neutralizing the delta of this future with these options to zero. So this 1 rupee 35 paisa of investment, what I'm doing, this is only a 35,000 rupees of investment is done, and this future is capping my 1.35 lakhs profit. So this 1,35,000 profit, I'm capping it and just hedging with this. What happens? GAIL has gone up, gone up, gone up to a great extent. Great 9th of December, 9th of December, I close this hedge, which I have bought at 1 rupee 30 paisa. You can just see the same date and time. 6 rupees 60 paisa, I am closing it. So almost I am getting 5 rupees 30 paisa added into 2. So 11 rupees. So now my hedge has come to 101 plus 11 rupees. So my profit is being protected till 1112. Though GAIL is at 120 rupees. 120 rupees. Further hedge is being made. You can say at 140 level also. Currently I have the hedge. So it is at 80 paisa or 90 paisa. Again I have taken some 85 paisa, some slightly higher quantity to make it as a delta neutral, and it is so. What I would have got by simply selling it by 101 rupees, what I did here, I'm just hedging it with that profit, so that 1,35,000 is not being taken out from me. Rather it has added some 12 rupees now, so profit has increased to a level. So you keep on hedging this process. What will happen? Stocks, any up move is not a permanent up move. Any fall is not a permanent fall. Say after 2 or 3 months of off move, if there is a correction. Say after 3 more months of off move, there is a correction. So after 2 or 3 months, if you carry on with this, your profit will be protected to the range of, you can say, 130 rupees or 140 rupees. So the moment the correction will be deep, and if the stock is correct by 10 to 15% or 20% from a higher level, what happens? So there you, whatever the equity profit is there, you pocket a maximum part of that, or you can just go on further hedging that. So by this process, It is a infinite process of bringing down your cost of acquisition. So my point is, if you invest in a stock, instead of choosing hundreds of stocks and putting 10 or 11 lakhs, choose any one stock and hedge it. Index stock and hedge it in this process with the process of 0.35 delta, and it has given an excellent result. Excellent result. So no need, it will enhance your profit and it can give you the major part. So now my last part. So we are just last part of the presentation. So last part I will discuss. Then after I'll go to your question and answers. So surplus money to carry on with this. Fine. So fine. So here, to move to the next part of my things, I have told you last part of my presentation how to book a profit. It is a most critical activity in your trade. But people used to say booking loss, stop loss point, because you don't, majority do not want to hedge. Stop loss is better. It is better to sacrifice the loss rather than using the mind and use, so that they feel it is easier process. Who will do this option hedgings and use the mind? Better to book the stop loss and come out. So I do not buy that idea, as all of you know. So here profit booking also is a critical activities. I used to say most of the traders, those who interact with me, many of you used to interact with me through WhatsApp and all, used to tell that, sir, I bought this stock at 400, I sold at 410, but post that the stock has gone to 600. Many of you used to tell. So though I was holding for 1 year, I got only 10 rupees, but the moment I sold, it has gone these things great way. It moment I sold, it has suddenly 50% gain, it has gone. So here I have two approaches or the two solutions for you. And recently these queries are flooded in our email. Many of our buyers, they used to say, we did like that. What, how to make that enhancements? How we could have prevented that? So here the part of doing the enhancement in profit is very, very important. Trade is not that repeatedly you enter and make small profit. Trade is that what is your profitable trade, that profit should be protected and the profit should go up and down. It is not that without doing any extra activities, without doing any extra stocks to choose, your profit in the same position should go up. So what I have done here, only withdraw the profit portion of the investment, which is very easiest thing. Suppose you have bought some 1,000 shares, you are getting 10% profit. So that 10% comes to suppose 5,000 rupees. So you sell only 5,000 worth of shares from your holding. Do not sell more. So that is one way. But what happens, again you have to reinvest and that loop will continue. So this is the easiest process, but it is not a mathematical process. Second process is the process what I have shown you in the case of GALE. Selling the future, buying multiple OTMs of 0.35. Second example I will show you in the Tata Steel. What I did here. Two lots of Tata Steels. This is the equity holdings. It's being bought in different times. First entry was happened on 15th September at 405. Though it is hedged, the last exit point I will show you. That is very, very interesting. Second entry, this is equity. Equity is buying same quantity. What is the quantity in F and O? Because I have to hedge it. So this is 374. So the timing, see 15th September to 6th October, there is a downfall of near to 30 rupees from my existing positions. So here you can say near to 50 to 50, 51, 50 to 55,000 rupees loss is there on equity, though it is hedged and it is being recovered. So here two things has been invested, near to 12 to 13 lakhs worth of investment is being sitting there. So the moment it has invested that, though that time it is being invested, but post that scenario is very important. November I thought of to come out. Post that event is very, very important. So when Tata Steel went to 428 rupees, so my investment 373 and here 405, it comes to some, I think 390 or 395 range it will come. So 395 for 400 rupees near to it is coming. So around it, you can say So 1.5 lakhs profit is there. So I do not want to sacrifice that profit, 1.5 lakhs profit. I have, what I did, I just say like the girl, I have sold this share 3,400 in futures. Hard value 427.95. So my profit I capped. So whatever the profit I had, so that same profit I capped it here. So my 393 to 427. So here I am not going to lose this 427. So this I have capped, and same times also, since my 380 and I'm selling a future, so what happens? I sold 380 put also, I have taken 480 put also, call also, multiple lots. So this is going to be held for a period of time. And what is I am getting here? You can say once this goes to 480 level. This was the November, December carry forward also it is there. So you can say that it is still one carry is there. So what happens here? So November, say I'm closing these things, closing the entire position. I don't want to carry on. So what happens here? This 3,400 shares, I'm selling it at 474 rupees. Trade value. So 16 lakhs rupees, I am getting it back. I want to close all these futures and options positions also. What happens here? Total 400, I could have sold at 430, 428. I'm getting 473, 474, 428. I'm just rounding it off. Equity, I am getting 6 here, 6 to us 4. 46 into 3,400. So equity is contributing 46 rupees more. If I would have sold at 427, I would have got 427 only. So now equity is contributing 46 rupees more. So 46 rupees more equity is contributing. So this I can say here, our equity is giving me 46 into 3,400. So here I am getting 1,56,000 rupees of profit, more profit in the equity. So I could have sold at 428. 428 profit is capped, but this 1,56,000 coming as an additional profit on my the same holdings. What is the hedging cost I have made it here? 57,000 rupees. I am said hedging cost of 57,000. I am losing here. So all in all, whatever the profit till 428 it is guaranteed, and you got another 1 lakh rupees 99,400 extra. Nothing wrong in that. So say after doing these things, you are feeling that okay, this stock is which has happened with me, which has also happened with me. I found out that okay, stock has given a long-term breakout or technical breakout, whatever you say, because many terms you people will be knowing better than me that on technical breakout, moving average breakout, 200 days, moving average breakout, say 515 above, it has given a breakout. Once it is given a 515 above breakout, the same process is being repeated. Stocks is being entered, future is being sold, along with that calls are being bought, and some amount of puts and other things. If I want, I can sell it off. So the technical levels or open interest, by looking at, you sell it off. So you can say that the new position what is being initiated, that also has given a great amount of profit. So two examples I am showing here, one Tata Steel and another this Gale. These two positions and many other such positions I have taken. SBI also I have taken. Reliance also been taken. So many other positions are being taken on the investment perspective. So my very idea or point of conveying you this message, have one or two stocks based on your appetite, because you can say that many of you invest 5 to 6 lakhs rupees, 7 lakhs rupees. Many index companies are having one lot value 5 lakhs, 6 lakhs also. So you can invest in that particular company, hedge it, carry on that trade. 10% or 15% or 0.35 delta above, you can just have a hedge and carry on with that positions. What happens? Your investments will never go to the negative yield. First benefit. its future will protect you, or it will reduce your cost of acquisitions. And if the profit comes, profit will improve. So what happens, the future, if it involves with your equity holdings, if the price fall by 20% or 25%, nothing wrong. Yes, future is compensating you that. So your cost of owning that particular share will reduce. One point of time, future you close and you think that there is a 30% or 40% correction already happened. So close the future and just have that holdings equities, hold for few days, there is a 10 or 15% of move happens, again start hedging it and protect that things. So with less number of stocks you can operate in a better way. But it is an advanced concept. It is, as I told you in the beginning, these concepts are being followed by the advanced traders. The traders, those who are having a lesser skill, they cannot able to digest this concept, nor they can able to imply these concepts. So from the very beginning part I have told, these are the concepts widely followed by the advanced traders. Do you think that the Rakesh Junjunwala, who is sitting with 15,000 crores of asset, he is just sleeping like us and thinking that no, this asset should not be hedged? So I'll be always holding it. It will, after 20 years, it will go to 30,000 crores. How can he leave this 15 lakhs rupees or 15,000 crores just like an abandoned child that it should fall at any time of time? Not like that. So most of the higher trading concepts involves little complexities, though I have given you some simple idea. Many more such ideas are there which you can able to implement in your investment. So you can not only for the trades, as I shown to you these two examples. These two examples are my own trade notes. Normally, very rarely I show these trade notes. I have shown you these trade notes. So here I have not sacrificed any profit. My profit have improved. I would have sold this, okay, 10% can sell the Tata Steel and come out. So why to say? Just have a take a chance. You have a profit, have a hedge, wait for a few more days. Let us see if it is giving you further some profit, it is good. If it not doesn't give and slips further, no problem. Let it come. So whatever the profit you have in the equity holdings, that will come to you from the future route. So here the very idea, you can protect your profits anytime you want, or the moment you enter the trade, from that time onwards itself you can start protecting it. So this is simple idea. Many other complex option strategies you can club with that to protect it, that I am not talking because that will become very complex. These are the simple ideas in which you can able to have a protection on your strategy. So if you tell me to enter a market when the Nifty has gone to 20,000, then also I can enter. If anyone tell me to enter to a market when the Nifty is at 1 lakh, I can enter. So that comfort you'll. So somebody has seen the market in 2009 at 5,000. So now market is 13,000 for him. If he doesn't follow any logic, what if market is costly for him? So it will never become cheaper for him. Anybody has seen the market at 2009 when the index has 5,000 and 2020 when the index has 13,000. Can that man will tell me at any point of time market is cheaper? Market is always costlier for him, isn't it? Anybody who has bought rice at 1 kilo rupees, 1 rupee per kilo, and it is 50 now, so he'll say that rice is costly. Where are those old golden days? He'll say that, where is those old golden days? I was earning 50 rupees salary, I was having a lavish lifestyle. This kind of stories you would have heard in many voices. Many voices you would be there. Many of you can tell me that same story. I was earning 50 rupees salary, I was having a lavish lifestyle. That same, now I am getting 60,000 salary, but with increments and all, but I am not able to meet this. Cost inflation index has gone up. This basic logics you people know. So here what happens, cost inflation index, once it goes up, why you think everything is costlier? So here you do not hedge your risk, so everything seems to be costlier for you. Once you hedge your risk, everything is always, it has a constant prices. Prices gone up has to fall down, prices fallen down has to gone up. That is the nature of the market. You cannot change that logic. Market is going up means it will never fall down, you can't say. If it fall down, it will go to zero. It is a impractical expectation. If it has fallen down, it will fall forever, it will never go up. That is also impractical expectation. So be a rational trader, be neutral. If you be neutral, you will definitely get some idea to make this thing, and these are the simpler ideas to implement and make money. As I told to you in the beginning, these concepts are new concept. Watch this video once it is being given to you. If you have not registered for the Hindi event, which is going to happen tomorrow, so download the documents. In the event, you have to separately register. As I told to you, while registering for the Hindi event, choose the date. So both the things you can do. ETF you can invest, Nifty ETF you can invest and hedge in the same process. That you can do. So yeah, this will be definitely one paid program will be launched in this. So with some additional concept, I've just given an intro. That is just given an intro with the 2-3 different ideas, so that people should know there is a way. My investment should not go to negative yield at any point of time. I can do it. Nifty, Bank Nifty, ETFs you can invest and you can hedge in this process. Nothing wrong in that. You can do that. So this part of the things is very, very important. There is a program is being scheduled, paid program is scheduled on option strategy, which will explain most of the hedging concept in the options. If you have interest on this subject, do join this program. Registrations are open. Another 39 seats are vacant. So if you want, you can join. So this will be the last option strategy programs for this year. So in Smart Finance, how our program flow happens, that also I'll tell you. In a year, near to 12 programs, paid programs used to happen. Paid programs used to happen. So these 12 programs will be splitted into two segments. 6 months you will get new subjects, and the next 6 months it will be repeated. So the same subject will be repeated 2 times. Like option strategy, it will be repeated for 2 times. Sometimes it happens for 3 times also, we used to do based on the people's demand. So whatever the programs happened in 2020, the same subject will not be repeated in the 2021. 2021 will be repeating the new subjects, new concepts, and the same Gann, Fibonacci, Elliott, all things, but new concepts will be repeated. So here 2020, if you have joined the option strategy program once, so maybe some new concept will come, but mostly that will be a repetition in the same 2020. You won't get any new concept on the options, but each time the program varies, new things comes into that. However, the 2020 option program and 2021 option program will be entirely different. So if you have joined a program in 2019, don't think that this same subject is being repeated now. It is entirely different. Programs, 12 programs will happen, paid programs. Out of that, 6 unique programs, and that will be repeated in the same year. Next year, the same subject will not be repeated. So tomorrow we have the same subject in Hindi. So if you have not separately, you have to register for that. Click on this link and register. And I will request all of you to give your review here. So I have given the link. You have learned some new concepts. So just give your review, how you like this concept, how useful it is. Just your thought you must share in our review page. So that is not a compulsory thing. If you think you have some social obligations to convey some rightful idea, you must do that. And this PDF what you have downloaded, there the links have been given. If you feel like, give a review here. Thank you very much. Thank you for your time.